What's going on, guys? Austin here, and in this video we are going to break down a very essential topic to long-term investing and trading success, and that is diversification. We're going to talk about what diversification is, why it's important, how to do it right, and how most people do it wrong without even realizing it. We're going to talk about how this applies to manual, active, and systematic trading. We're also going to talk about how this applies to long-term investing as well. So let's dive right into it. We'll jump first into how it works overall and why most people get it wrong. So diversification is basically when you just allocate capital across different types of asset classes. Now, most people think that they're diversified properly, but in fact, they are not. And what do I mean by that? Well, most people probably have a stock portfolio of maybe a couple index funds. Maybe it's the S&P 500 and the NASDAQ. Well, hate to break it to you, but those things have a very strong correlation and typically go up or down in similar times. So if stocks are getting crushed, that whole portfolio is getting crushed. That's not really a proper use of diversification. Maybe though they justify it because they have a rental property and maybe they own some crypto as well. So they say, oh, well, it's okay if my equities portfolio is down because I'm diversified in all these other asset classes. But if you're going to do it something, you might as well do it right. So with that being said, let's dive into how you could properly do that into each individual section. Then we're going to talk about how this applies to manual trading and systematic trading, and even look at some real world examples as well. So going back to the example of somebody that may have a equities portfolio, maybe they have some real estate and maybe they have some crypto. We'll start with the equity side. So if you have a long-term equities portfolio, which is a very good thing to have, just owning, S&P ETFs and NASDAQ ETFs is a good start, but it's definitely not a diversified equities portfolio. So if you have exposure to the overall market, which is basically the NASDAQ and the S&P 500, if those indices are going up, well, then that's great. But if they both start going down, then you're kind of screwed because they're both moving together for the most part. They have a very strong correlation. Now, if you were going to properly allocate to that, maybe you have exposure to some commodities as well. Maybe you have gold ETFs. Maybe you have some defense sector stuff. Maybe you have bonds. Maybe you have exposure to even some REITs. Things that are going to have low correlation to each other, and it's quite simple to figure out what the correlations for this stuff is. If you work with a financial advisor, they should definitely be doing this. If you don't work with a financial advisor, that's okay. You could really find the correlation data between a lot of very common ETFs very easily on the internet. So a better look at that portfolio would probably be exposure to, equity indices like the S&P, the NASDAQ. Maybe you have some gold ETFs, maybe you have some REITs, maybe you have TLT, so you have exposure to treasuries and bonds, and that's going to give you a little bit more diversification. Now, aside from that, if you're going into a real estate example, if you just own, one house in one neighborhood in one particular state, well, that market could be very different than the market in, let's say, New York, or the market in, let's say, Florida. But you don't even need to go across different state borders. Maybe you just have different types of property that you invest in. Now, I'm no expert in being a real estate investor, so I'm not going to sit here and act like I am. However, the element of diversification certainly applies. Somebody that only owns one property in a particular neighborhood is certainly at the mercy of the market in that particular neighborhood. Of course, there's going to be buyer and seller markets going to be based on interest rates that applies to across all of the United States. However, when you own different property types, you certainly are dealing with different types of clientele, different types of buyers, different types of sellers, and different dynamics across those different fields. If we're talking about crypto, if you only own Bitcoin, well, then you are at the mercy of whatever Bitcoin does. But if you have Bitcoin, Ethereum, XRP, maybe a bunch of other random crypto coins, then you are going to have a different experience compared to if you are fully invested into one thing. Now, again, correlations play a strong part in this, just like they do in equity indices. So if you are going to be, all exposed to Bitcoin and Ethereum, you're probably going to have very similar movements across those assets because the correlations are very strong. So understanding correlations is an incredibly important thing. Now, let's get a little bit more granular and talk about how this applies to trading strategies. So let's assume that you're a manual trader. Maybe you're trading a very simple strategy. Let's call it an opening range breakout strategy. If you only trade an opening range breakout strategy, then you only make money when that strategy makes money. However, if you trade another strategy in a different asset class, or maybe even the same asset class, but a totally different approach, then now you can actually hedge the performance of those two systems against each other. And what this is going to do is increase your amount of opportunities and also allow you to have the ability to hedge those systems against each other. Now, I just mentioned that, but what that means is when one system makes money, maybe the other system loses money, or maybe the other system makes money as well. Again, this all goes back to understanding the correlations. Now, this is an incredibly powerful thing and an absolute must-have in any type of portfolio, whether that be a trading strategy, whether that be a long-term equities portfolio, whether that be a real estate portfolio. You are going to want to have levels of diversification so you can have more opportunity and be able to hedge the performance of things against each other. Now, let's go more into the trading examples here because that is really the purpose of this video. Let's say you have strategy A, B, C, and D. And strategy A and strategy B are both making money, strategy C is flat, and strategy D is losing money. Overall, you're probably going to be profitable, assuming you have an equal allocation to each strategy because two are doing well, one is flat, and one is down. Now, if you had exposure into only one strategy, let's say strategy D, for example, you wouldn't be having a good time because it's losing money. If you happen to be lucky and the one strategy that you were trading was the one that was making money, well, then you think everything's good until that strategy has a drawdown, and then you are basically at the mercy of the market environment being favorable to that particular strategy's rule set. Now, we can go a lot more granular in this, but the very simple way of doing this is just talking about it in percentages. Okay, so if you put 100% of your portfolio into one single asset or one type of strategy, then you are taking 100% of that asset or strategy's risk. Now, if that asset drops by 20%, your entire portfolio drops by 20%. If that asset drops by 40%, then the entire portfolio value drops by 40%. All of your risk is concentrated into one place. And this is what you could call idiosyncratic risk. It's where you have all of your exposure tied to one thing. And the great thing about idiosyncratic risk or concentration risk is that you can diversify it away. So let's compare that to spreading your capital equally across 5 different assets or strategies. When you do that, each asset or strategy is only going to represent 20% of the portfolio. So instead of being 100% exposed to any one thing, you only have 20% exposure. And that means the impact of any single asset or strategy on your total portfolio is reduced from 100% down to 20%, which is an 80% reduction in that concentration risk. Following so far? Pretty straightforward stuff. So let's say any one of those assets drops by 20%. Instead of losing 20% overall, you only lose 4%. If it drops by 40%, instead of losing 40, you only lose 8%. It's the same loss inside that one particular thing if you're looking at it on a line-by-line or case-by-case basis. But that portfolio impact for the whole picture is dramatically smaller. Now, the 80% reduction is assuming that those assets are completely uncorrelated, meaning they don't at all move together. And in the real world, assets do have a level of correlation, which means the risk reduction might not be a full 80%, but it's going to be pretty darn close, so long as you make sure that the assets that you're basically diversifying into don't have incredibly strong correlations. Ideally, you want to keep your correlations between like 0 to like 0.35. 0.35 is going to be a pretty low correlation. Basically 0 to 1 is how we're going to be measuring doesn't move together at all, and 1 is going to be moves the exact same. And then on the other side of the spectrum, you have -1, which basically moves the opposite. So if you have exposure into something that's -1 and exposure into something that is the baseline, well then they are going to move opposite each other. One's going to go up while the other one goes down. If it's 0 and 1, maybe one of them doesn't do anything while the other one does something. So that's how you measure correlations. You measure it on a basis of -1 to 1. I would say for my personal preference, the most exposure that I would want to have in terms of a specific type of portfolio would be 0.35 across different assets. So unless your correlation is extremely high, you're going to have a very, very significant amount of risk reduction. So you definitely don't want to have all your assets moving in the same direction at the same time. It doesn't really help you with the purpose of diversification at all. You're basically just trading the same type of movement across different types of assets, which really defeats the purpose. So overall, diversification is going to always reduce the overall portfolio risk. So the big picture here is very, very simple. When you invest in just one thing, you absorb 100% of its downside. When you spread across 5 different things, assets, or strategies, the impact from one is basically capped at 20%, assuming they don't have any correlation. And that is why diversification is one of the most powerful tools in risk management. It mathematically reduces how much any single loser can hurt you. So Ray Dalio is the founder of Bridgewater Associates. It's the largest hedge fund in the world. So this guy definitely knows what he's talking about. And he famously talks about what he calls the holy grail of investing, which is when you build a portfolio with 10 to 15 good, uncorrelated return streams. This allows you to earn the return of a single strong investment while taking a fraction of the risk by reducing the concentration risk. So when your return streams aren't highly correlated, they don't lose money at the same time. One might pull back while another holds steady or starts outperforming. So instead of having that 100% exposure to one outcome, your risk is spread across many independent sources of return. And that is the essence of what Ray Dalio calls the holy grail. Combine multiple uncorrelated return streams and keep the return but slash the volatility. And this is what the guy who founded the world's largest and most respected hedge fund does. And it's the same exact principle behind any intelligently diversified strategy. So with that being said, let's go take a look at some real examples of this in action with some of the algorithmic trading systems on my platform Algo Exchange, where users are running over $70 million of live capital. All right, guys, so here we are on the Algo Exchange platform, and what we're looking at is the portfolio builder tool. So the portfolio builder essentially allows you to combine a bunch of different algorithmic trading systems together and assess the performance. Here you can see on the page, we obviously are showing, a little pie chart of the different strategies that are selected. Here we're showing a bar chart of their individual capital allocations. And then if we run this, it'll actually tell us the performance. Here we have the menu of different systems. So we have two different pages of systems. We show the returns, the drawdowns, and the capital allocation. And then here we have the correlation matrix. So obviously we were talking about correlations earlier, incredibly important. So we want to make sure this information is front and center so you can assess the relationships from the different strategies to each other. Obviously this is going from a -1 to a +1 scale, so you're able to see if they move similarly, if they move opposite, or if they really have no relationship at all. So if we go ahead here, I could select the date. I did January 1st, 2025, and if I run the simulation, it's going to then show us the blended return and the blended drawdown of running the portfolio together. Now, it's very important to consider here that what we're looking at is going to be the volume-weighted average price of all the real-life fills for each individual strategy is what we use to get this data. So this is not a back test. We're basically using the real fills across every single live account connected to each individual strategy to come up with the fill prices that we use for these model accounts, okay? So here we can see the blended return is 30.5% and the blended drawdown is 9.17%, which is a very, very good ratio in my opinion. A 30% return with a 9.2% drawdown is definitely a nice thing to have. And here you can see the consistency is definitely very obvious, right? So 80% of the trading months so far have been profitable, despite only 28.8% of a win rate on a per trade basis, largely because the average win-loss ratio is 3.2 to 1, so you're making 3.2 for every dollar that you risk. And here we can see the individual equity curves. So this is showing us the performance of all of the different systems here. If I go ahead and turn that off, we can basically hover over each one, and it's essentially showing us how the different systems perform against each other. If we click each one here, we could actually see the individual equity curve by itself. Okay, so we're able to see how each different strategy has different periods of performance and lack of performance. For example, Cairo was not even trading until March. But when we look at the portfolio, it is very, very balanced, and you have much more stability. If we compare that against the S&P 500, you could even see the divergence against the S&P 500. So the algorithmic trading portfolio gained value while the S&P lost value here in April when the tariff announcements happened. So this is going to be a very, very important thing to have if we're talking about diversification from a 30,000 foot view. Maybe you have exposure to the S&P 500 in equity markets in your long-term portfolio. This is where having an algorithmic trading portion of your portfolio would have helped you out, allowed you to hedge the asset or hedge the drawdown of your long-term assets from having this type of allocation. And here you can see the outperformance is obviously very evident as well. So that is going to be a nice example of a blended portfolio of different trading systems, and you can see how different systems either made money at certain times, how they were losing money at other times, but when you blend them together, the performance is incredibly consistent. Now, if we want to take a deeper look at that, we could actually draw our attention here to the performance table, so where we see the monthly performance and this header here. If I go to this drop down, I could actually select each individual strategy. Now, when I do this, these numbers will change. The equity curve will not change. So let's keep our attention on the numbers in the performance table. If we go to just Titan, right now the blended portfolio has a 9.2% drawdown and a 30.5% return. So remember that. When we go to Titan, we have a 17% drawdown, but we have a higher return. So 46.7% return, 17% drawdown. Here we can see only 63.6% of the trading months have been profitable. We lost money here, we lost money there, we lost money in these 2 months, whereas these months have been profitable, okay? We flip over to Apollo. Only 54.5% of the months have been profitable, 33.6% drawdown with a 34.7% return. Here we can see, obviously, sporadic wins and losses across the different calendar months. If we go to Tango, similar thing, 63.6% of months profitable, 14.4% drawdown, more conservative return at 20.7%. And again, you can see a mix and a little bit of a variety here of the monthly performance returns. Now, we go over to Cairo. This thing wasn't even trading until March, so there's no return for January and February. And then March, April, May were profitable, June, July unprofitable, August, September profitable, October red, and then November we are slightly green. 10.5% drawdown with a 35.7% return, 54.5% of months profitable. If we go to Falcon, we could see only 36.4% of the months have been profitable, 4.3% return with a 16.7% drawdown. And here we could see a little bit more red than green here. Now, when we take all of these individual strategies and we blend them together, this is what we get. We get a nice return with a very, very, I would say, reasonable drawdown, 80% of profitable months, and a much, much more stable equity curve. And this is diversification in action, right? So we talked about the concept, and here you are seeing it in practice. So this is not just a theory, it actually works. But the main thing here is you have to make sure that your correlations make sense, that you're not overexposing to strategies that have strong correlations to each other, and you're actually doing this the right way. So here we could see a really, really nice example of diversification in action, and you could actually access these same exact trading systems with your own capital through the Algo Exchange platform. We have over $70 million of client funds flowing through the platform as we speak, and this is a great example of a nice blend of these trading systems. So this is how it works from a trading system perspective, and obviously from a 30,000 foot view, if you have this in your portfolio, it is incredibly important. And diversification is really one of those things where you need to really get a little bit more granular with it and think about it from your, I would call it your subsector level, right? So let's say someone has a portfolio of long-term equities, they have our investment property, they got some crypto, and maybe they're using an algorithmic trading system. Well, if you only have exposure into maybe like one or two things in each category, it doesn't really do you very good, as we saw here with the algorithmic trading example. If you only had exposure into one of these strategies, well, if it was only Titan, then you were doing pretty good, right? But if it was, so Titan, let's say that was the only system you're using, you're a happy camper. But if the only system you had exposure to was, let's say, Falcon, well then you're not super happy, right? So that is why diversification is incredibly important, because when you have more exposure to multiple different ways to generate alpha in a particular category, you're going to have a better experience. So let's talk about diversification with manual trading. So if you're executing a manual trading strategy, this is definitely going to be different than how you would diversify from systematic trading strategies. However, there are some very important similarities and there are some key differences. So we'll just simplify this and jump into it. So if you're trading multiple different strategies in the same asset, like for example, NASDAQ futures, you want to make sure that you're doing this in two separate accounts. And the reason for that is because if one strategy wants you to go long and another strategy is telling you to go short, well, then you're basically net flat. So if you have two separate accounts, you can execute your long trade, you can execute your short trade, and basically just let the best one win that day. Another thing that you could do is basically trade the NASDAQ futures on one side and then trade the ES futures, the S&P 500, on the other side, and that you could do in the same account, no problem at all. So with that being said, that's basically how you'd balance that out, and that is a very, very important thing to consider, because you definitely don't want your signals to counteract each other, and then you basically be, well, hey, this one told me to go long, this one told me to go short, I can't do either, because if I buy one and I sell one, I basically have zero, right? That doesn't make sense. So essentially you want to be splitting that up across different accounts on the same asset, or if you want to trade different assets, then you can do it in the same account, no problem. So some examples of this in manual trading is essentially having different setups in your playbook. So let's assume on NASDAQ futures, you are trading, some type of momentum trend following based system, like an opening range breakout. So here you're basically looking for the trend to continue throughout the entire day. So that is a trend following strategy. Now, on the other hand, maybe you're trading a mean reversion system on the S&P 500 that is essentially getting short while your opening range breakout trade on the NASDAQ is getting long. Now, ideally, you want one of these systems to work, and basically you'll end up probably net flat or positive on the day, depending on your risk management system there. So ideally, your winners are much larger than your losers. So you take a small loss on one, you have a big win on the other, and you end up positive. So that is basically when those strategies would have an inverse correlation to each other. If one's going long, one's going short, that's pretty opposite. Now, another thing to consider here is if you're going to be doing this on the same asset, like we mentioned, obviously you want to be doing two separate accounts. So this way you're not going to be conflicting with the trades, but you also want to make sure that the systems aren't moving too much in tandem or have a strong correlation, because then basically you're just amplifying your risk. If you're trading two trend following based systems on the same asset class that pretty much have similar results most of the time, well, then you're basically just taking on more exposure for no reason. So that kind of defeats the purpose. So you definitely want to make sure that strategies or the setups in your playbook have a reason to be there. So if one's a trend following system, the other one's a mean reversion system, that definitely makes a lot of sense. If one of them's more of a swing trading strategy and the other one's a day trading strategy, that definitely makes a lot of sense. You just don't want to be doing essentially the same thing for different reasons in the same exact asset, because then you're essentially taking on more concentration risk and doubling up your exposure for essentially the same thing but for a different reason. So you don't want to do that. So that's kind of how it would apply to manual trading. You just want to basically have different setups in your playbook and obviously make sure those setups have a unique purpose. Maybe one's going short, one's going long, maybe one's mean reversion, maybe one's trend following, or you could basically trade the same type of strategy, maybe trend following strategies, across uncorrelated assets. So that is another unique approach that you could do. If you don't want to do the whole multi-account thing, totally fine. You don't want to trade different trading rules or different trading setups, you could trade the same setup across uncorrelated assets, and that would also accomplish what it is that you're trying to achieve. So that's one way that you could do it. Now, with systematic trading strategies, it's going to be totally different because there's a lot more variables to consider here. Systematic trading strategies like automated trading strategies and algorithms, you probably want to be doing this in different accounts because there are so many different reasons that you could basically deploy trading algorithms to do certain things in the same exact asset that could also have very, very different results. So I would definitely consider that more portfolio construction. This is more of a hands-off passive thing that you'd want to set up and basically just monitor that the systems are obviously executing properly. But from there, you could be running 25 different strategies all at the same time, and that's much easier to do than executing 25 different strategies manually. So with algorithms and systematic strategies, there's a lot more variables, a lot more happening at the same time, and that is going to be a totally different beast. But we'll go ahead and take a look at some of those examples as well, and that is going to be a key thing about that there. And that pretty much wraps it up for this video, guys. So diversification is a crucial element. Ray Dalio, guy founded the biggest hedge fund in the world, he calls it the holy grail, but you have to make sure you're doing it right. You want to make sure that you don't have strong correlations across the assets that you're diversifying across. If you're going to be diversifying into different categories or sections of your portfolio, you want to make sure that you diversify within each section, like we looked at when we showed the platform and showed you how that works. And this is going to be an absolute incredible game changer for any type of asset class that you choose to have exposure to. So I hope you guys got value out of this video. Make sure you hit the like button, make sure you subscribe, because I'm going to be making content like this where I drop value like this and give you guys different types of insights. I hope you guys enjoyed this video, and I will see you in the next one.